Okay, everybody, gonna get right to the point. My newsletter for the weekend said this is crunch time for the market. And we really got to start seeing some real movement back to the upside in order for us to feel confident that the market is still in gear. And I have to say that today was very, very impressive. Let me tell you why I think today was so important. It has to do with the fact that whether you look at the NASDAQ composite, which is every stock, which is all the NASDAQ stocks, or you look at the NASDAQ 100, or you look at the S&P, or you look at the Russell 2000, when it comes up. There you go. What you see is something very, very important. You see 2 days in a row with some very, very strong follow through today. And that is very, very important to the market. Okay. Now, it is a holiday shortened week, and we really don't know what's gonna come when everybody gets back from vacation. I'm sure the Hamptons will miss all the traders and hedgies that come out to relax on the sand and party. Hang on one second, folks. We're getting some slow response time today. Let me go back to this NASDAQ one. There we go. So this is really, really cool. We got an outside day yesterday, and we have a follow through today with a slight gap opening. See that? That slight gap. And a close near the daily highs. A very, very impressive day. Very impressive day. So we're going to keep our fingers crossed that things are going to continue. Although, as you know, over here at the Rich Options Jerk, we really don't care what direction things are going in. We just want to find trades that can make us money. And speaking of that, I want to review a couple of trades here. We actually found a couple of new trades in the last 2 days. One in Celgene and one in TripAdvisor. Now let me go. What we did TripAdvisor yesterday, where we bought the October 40 call for $3.40, and we sold this week's. We were very aggressive because we really weren't sure what was going to happen this week, and yesterday was Tuesday, and we sold that for 50 cents, which got our cost down right out of the gate at $2.90 with 7 weeks to go. Now, today was another strong day for the stock, and as you can see, this option is now 57 cents in the money, trading at 82. So if today were the expiration day, this option would only be worth 57 cents. It would only be worth 7 cents more than what we sold it for. And tomorrow's Thursday. However, our long option is up to $3.90. When you look over here at the Greeks, you could see that the deltas are kind of flat. Okay, why are the deltas flat? Well, they weren't flat when we started because the short call wasn't in the money. But as you know, at the money calls. This call was actually slightly out of the money, but the shorter time you have to expiration and the closer the option is to the strike price, the higher the gamma. At the monies always have the highest gamma, and at the monies that have the shortest expiration all have the highest of the highest gamma. Why? Because on the expiration day, an option will either have a delta of 0 or a delta of 1. Well, think about it. If an option is at the money and you're getting close to the last day and the stock oscillates between being slightly out of the money to being slightly in the money, as you get closer and closer to expiration, that delta is going to swing very quickly between 0 and 1, 0 and 1, 0 and 1. Okay? Or let's say it's a week before, so it might go between, let's say, 35 and 65, 35 and 65, 35, 65. As you get closer to the expiration day, it goes between 0. On the expiration day, it's going to be 0 or 1. So the higher gamma in this option that expires in 2 days, well, it has pushed this delta all the way up to 68. So right now, the net delta of the position is 0. So actually, if the stock goes up, if the stock goes up, nothing is going to happen because of the delta. But we still have a slight nickel of positive theta with a couple of days to go. In fact, that's the average theta, right? If you think about the theta is going to be 5 cents a day, well, this theta is 7 cents a day with 2 days to go, but it's got 21 cents, it's got 57, it's got 25 cents of extrinsic value to get rid of. So obviously 7 cents a day times 2 is only 14 cents. So this theta is going to ramp up really, really quickly. Okay, and I'll show you how we would model a potential roll in this as well. But let me show you the chart and let me show you why we got so excited about this. So let me go back to TripAdvisor. As you know, we haven't been doing a lot of trades because if you look at the way the market's been, it's been really crazy. It's been a very difficult time because you never know day by day what the market's going to do. There is really no discernible trends. Okay? But in TripAdvisor, we got interested for a couple of different reasons. Let me expand this a little bit. So you could see, well, number one, you could see you've got this bottoming action all the way over here from June, I guess late May, all the way through June, July, August. You had the breakout above that resistance right there. You could see we're above the 21 and the 9-day moving averages. We go up, come back down, successfully test that bottom, that breakout, new support, old resistance becomes new support. The stock goes back up to 44 and very, very nicely settles down back to this area. And with it staying above the moving averages, the stochastics still looking strong. Right? Strong stochastics are good. Obviously, we would love, you like to catch it on the bottom when when things line up, but that's nice to see some strong stochastics. The stochastics did not fade. We had this pullback, and the MACD histogram is still positive. And the RSI, the stochastic RSI, which I prefer to use as opposed to the regular RSI, also is kind of in the middle here. So we're not, and the DMI is positive as well. And those of you that look at Chaikin money flow, also positive. So anyhow, what we saw here was a stock that had broken out, pulled back, successfully tested, made a new high, pulled back, and started going up again. So we could easily see the stock get back up into this 45, 46 range, which quite frankly for us would be quite sufficient to make a nice little profit in a short amount of time and recycle the money. So let's go back to that trade. And let me show you how we might actually model that trade out. So let's start, no, not Alibaba, not Celgene, we don't want that one, not eBay. Where is it? You can see I've been working on a lot of trades lately. All right, there we go. So here's our current risk profile. Let me get rid of these two here. So let's add the TripAdvisor trade. All right. So here's the TripAdvisor trade. Cost us $290. We're short the 42 call, which is right there. As you all know, in the diagonal spread, we're always looking at the maximum profit in the short run at the strike price of the near-term short call. At the strike price of the near-term short call. Okay, so that wouldn't be too bad. That would be 54 bucks. We only spent 290. That would be almost a quick 20% return. Right now we're over here, which only gives us a profit of 36 bucks. Right now our profit is about $17 because we still have a couple of days left to go, and that $18 clearly is the net positive theta that we experience if the stock just stays there. Okay, now we're going to add a simulated trade. The stock right now is 42.57. So let's just say that we wanted to roll. So where are we going to roll to? Well, let's see. We want to roll up and out because we're at 42.5. So let's see what would happen right now if we rolled from the 42 call to the 42.5 call for next week. So we're going to buy this guy back. And we're going to roll out to this guy. Okay. Now, before I actually show you the results of the roll, what I want you to notice is that the volatilities are pretty much in line. In fact, we might be getting away a little cheap here on the option we're buying back and getting a little bit more for the option we're selling, which wouldn't be a bad thing, right? Getting a little volatility edge is not a bad thing. Okay, so we're going to do this. It's a small credit. Why? Because the option that we have that we're short is in the money with some time left. Hold on, I got to get this. Got to get this down to 1. Whoops. There we go. So we got that at 1, and now let's look at the new risk profile. Remember, we started at 290. So if we take in a 15-cent credit, that'll get our cost down to 275, but our short strike will now be 92.5 instead of 92. Okay, so we're not only going to collect the 15-cent credit, which is very, very low, as I said, because this option still has a few days to go. See, it has a 7-cent theta, which is going to increase quite rapidly. The theta of this option is only 5 cents. So let's take the risk profile, the new risk profile. Now let's see what our little adjustment here does for us. Okay, let's wait for it to come up. Again, sorry for the slow speed here today. Whoops, that came back to 5. So hang on, let me shrink this back down to 1. Here we go. And let's move this to the second expiration, since we're now modeling these. Here we go. And now you could see that at 42.5, we're now at an $87 profit with the stock at 42.5, which means if we decided to do the roll right now and the stock stayed exactly where it is, it actually went down 7 cents because the stock's 42.57. Okay, let's actually, to be accurate, we'll move it up to 42.57 right there. So we got an $85 profit, okay, which means we picked up that extra 15-cent credit, okay, and we picked up some extra money because of the theta decay now of the option that we sold, right? Because our net cost is only $275. So remember, at 42, at 42, we paid $290 and we had a $54 profit at 42. In this roll, at 42.5, we have a $2.75 cost, but we have at 82.5, at 42.5, we have an $87 profit. Okay? So that extra 33 cents, right? Actually, the stock is 7 cents lower than it is now. So how does the stock go down and we end up making an extra 33 cents? Well, that's because of the theta, right? The theta in the shorts is more than making up for the theta of the long. And if we keep doing that long enough, we have until October, we have 7 weeks, this thing could really turn into something very, very attractive. So that's the trade in TripAdvisor. And as you know, if the thing doesn't go our way, we can either take it off for a small, hopefully for a small loss, maybe 40 cents, 50 cents or so, which would be less than the average profit that we're getting on the trades that we've been taking or profitably, and move on to something else. But I think we're pretty confident that this is a nice little move here, and ideally we'd like the market to maybe take a little pause here and give us a chance to experience a little more theta decay so that we can suck out a little more premium. In fact, the best thing might be for it to go back to 42. And we'll have to see how the premiums play out. Okay, what was our other trade? The one we put on today, which I actually missed in my live account, was in Celgene. I actually did the trade in this account first, and I actually missed it. I was talking about the biotechs, I think, on Monday, that they were starting to show some life. We're looking at the IBB, and because of the condition of the market, I was saying that we really had to see, again, follow through follow through in the market. And as you can see, this looks very, very similar to the TripAdvisor. We got the stock at 134.34 on the close. We are challenging some resistance over here. The MACD, the longer term MACD is not in gear yet, but the shorter term MACD is. The stochastics have really come off the bottom. The RSI stochastic has come way off the oversold and is showing some real strength on this rally. The DMI is positive. Jake and money flow heading into positive territory. Okay, so what did we do on this guy? Well, what we did on this guy is we bought the October 2130 call for 675, and we sold this week's 135 call for 45 cents. Now this one got a little nerve-wracking. We got a little anxious about this today because just like the TripAdvisor, the stock actually, hang on, I got something extra in there, so hang on. Get rid of that. Okay, there we go. So just like the TripAdvisor, the stock rallied strongly throughout the day, got up to almost 136. But we did see a pullback finally at the end of the day, and the stock closed at 134.34. Okay. Now, what are the current prices? I'll come back to this in a second. What are the current prices of the options in our position? So you could see, again, apologies for the delay. There we go. So there you go. Right now, right in here, the spread is worth, let's say that's 70 cents, 7.25. That's 6.55. So we're up about 25 bucks per spread in one day, which is actually pretty darn good. And this option is now out of the money. So this, you can see it's got $15 of theta. It's going to lose 70 cents in the next 2 days. And this only has 4 cents of theta. So we actually got 11 cents of net positive theta. And this trade, because the option was short, is still out of the money. It has a positive delta of $26. So the stock going up tomorrow actually would be a good thing for us, as opposed to the TripAdvisor. The stock going up from here is actually going to put a little dent in our short-term profitability because the 42 call delta is going to actually go up a little bit, is going to go up faster than the delta of the 40 call. Okay, so here we are on the sell gene. Now let's go back to the trade itself so you can see where we're at. And let me get rid of these because these are the ones I was playing around with. And I tried to do the trade for $6.30 myself, but the stock had moved so fast it actually moved away. So here we are. There's our little profit we got right now, 28 bucks or so. If the stock stays right here, we'll have an $86 profit, which on a $630 trade is maybe, what, 14% or so. So again, not bad for a couple days work. But if the stock can get back to 135 and stay there, that would be almost $120 for a couple of days work, which would get us up towards the 20% range. Okay, now let's do what we did before in the TripAdvisor. Let's add a simulated trade where we buy this guy back, but because now the stock is 134, why don't we just roll to next week's 135 call? Right there. Now that will bring in 68 cents, which is super. Because now, and again, this case, we check the volatilities. You can see the volatility is a little disadvantage there on the roll. Not too bad, maybe 1%. And with this Vega being 9 cents, we're probably, if this is a 1% difference, we're probably getting 9 cents less for this one, or we're paying more for this one on a relative basis. Okay, so we should, if the volatilities were in line, we should get a little bit more, but you know, that's the breaks of the game. It's not that much. It's not like we're looking at a January option where you have Vegas in the 50 to 60 cent range. Okay, so this would give us a 68 cent credit, and that would take our cost down to $5.62. Same strike price though. Okay, so now we'll be long to 130 and we'll be short to 135. And let's take a look at that risk profile. And then we'll go again to the second expiration. There you go. And at 135 next Friday, our profit is 156.50. 156.50. Our at expiration for this Friday, if the stock gets to 135, that would be 120, what was that, about 123 bucks, 125 bucks? Let's get right on there. We can. 135.12, 135.09. There we go. It's about right. Yep, sorry. There you go. 123. Okay. So that 68 cent credit results in a $33 net profit. Why? The reason is that we do have in the option, oops, that's eBay. Hold on, sorry. Sell Gene. Because this is a little bit higher priced option, we get a little bit more theta in this guy over the next, what's today? Wednesday, right? Thursday, Friday, Saturday, Sunday, Monday, Tuesday, Wednesday, Thursday, Friday, 9 days. So there's that 27 cents right there. So we're getting $33 more profit because we're assuming we'd be losing all of this premium. Where is it? Right here. Right? We'd be making that 68 cents. Okay. The stock really is only going up 64 cents, but we're losing the 4 cents a day theta on the long option right there. Okay, that's what happens when you keep the strike prices the same, right? You don't get the same bump as if you roll out and raise that strike price, because when you raise the strike price, you give the long option a little more headroom, right? If we had rolled to the 136 instead, we'd pick up less premium, but we'd make it back on the move of the stock to 136 because we'd get more effect of this delta here of the option that we own. We'd get $1.65 to the strike price versus 66 cents to the strike price. Yeah, so that's how that works. And again, these are the concepts that you see us talk about over and over and over again. Maybe when things quiet down, as I said, you'll see more of the credit spreads. But right now, when something comes up, more than likely, you're going to see some type of diagonal spread. Let me make mention of our eBay trade here. Actually, our JP Morgan trade, very interesting. Again, this is a perfect example of what's going on with time. Is because we started this trade back on July 25th, it's been going on for a month already at $3.57. Right now, we're down to $2.21. So even though the long option has gone from $4.15 to $2, that's really only 20 cents. That's only a 20-cent loss. It's not a $2 loss, and it's not a $1.55 loss based on the original cost. So if we still have a couple of weeks left to go, so if we wanted to, which we probably will, we want to take this at least one more week. We actually have 2 more weeks after this. Okay, let's get rid of this. Okay, what if we wanted to do one more roll? Remember how we did this last time? Okay, let's say we wanted to roll this to the 92. So if we buy this for 9 cents and we sell this for 44 cents, there we go. That's a 39-cent credit. Okay, so a 39-cent credit off of 221 would get us down to only $1.82. Okay, well, in order for this to be adjusted to $1.82, this number, which is 363, to model the $1.82 risk, we need this to actually be $1.81, which gives you an indication of how much premium we've actually collected along the way. It's an enormous amount of money. So let me adjust this. And now you'll see let's see where we'd be at if the stock now was just 92 next Friday, because the stock's 91.31 now. Okay, we did get close to 92 today, so we're getting a little excited about this trade recovering, but it did kind of slip into the close. But anyway, let's look at this. There's our risk profile. We got to get to the second expiration, so excuse me for that. Okay, what's going on here? We're buying the September. Got a $1.81 credit. Oh, geez Louise, I'm sorry. There's a 5 lot. Hold on. This is before we changed back to looking at 1 lots to make it easier to track. There we go. So now we would only need the stock to be 92, and we'd make about, what's 5? That's 30 some odd cents. Okay, which again is not a super duper return. It'll only be about 10% on the original invested capital of 357. But the point is that we started out with a trade that was $3.57, and we'd still make money even if the stock was only 92. We still make money. And that's part of the magic of working with stocks as they move through time. Okay, so this JP Morgan trade is still alive. I'll say just one final word on this eBay trade. This is a tip. I do have this in a live account as well. This is, and I did sell half of my position today at 40 cents. I also paid 84 cents for it. So I took a 50% loss on half of the position because I didn't want to risk anymore. Because we did get a move back up here to almost 36. And with time, we only have a couple weeks left. I really, if I could eliminate, if I could get out of half of them with a 50% loss, then 100% loss on the remaining wouldn't be pleasant, but it wouldn't be as bad. So this is the kind of example where, I don't know whether you're watching this trade with us or not, but if you did have multiple lots of a trade like this and you get a rebound to a place where you have a 50% loss, it's usually a good idea to think very seriously about lightening up the trade. Because if we're taking a 40-cent loss, remember, a lot of the trades that we're doing, our average gain is much, much more than 40 cents. So having a loss of 40 cents or a loss of 20 cents or whatever it is, maybe even the occasional loss of $1 or so, like we have on the AbbVie, it's really not the end of the world, because if your batting average is high enough, you can afford to take losses, and some of those losses could even be higher than your average gain because the percentage of wins is so high. Okay, so far, the trades that we've closed out in the educational portfolio, fortunately, so far, they've all made money. So we feel pretty good about that. But right now, the AbbVie's not looking that great. The Verizon is kind of a wash. The eBay looks like it's probably going to be a loser. The Schlumberger goes to November, and that's the one that I'm most worried about. But we'll figure something out there, and we'll just keep plugging away. So everybody have a very enjoyable holiday weekend. You know where to find me, Elliot at investingshortcuts.com. And I look forward to, oh, you know what? We're not going to have a webinar on Monday because the market's closed. So I'll see you guys next Wednesday. Have a good one.